It is a quiet, universal routine. You agree to a specific annual salary, but on payday, the direct deposit alert hits your phone, and the number is noticeably smaller than you might expect. To understand where the rest of that money goes, we have to look at the difference between gross pay, the total amount you earn, and net take-home pay, which is the actual amount deposited into your bank account. That gap exists primarily because your employer is legally required to hold back a portion of your earnings for federal tax withholding. Before we look closer at these deductions, it's important to note that this video is for educational purposes only. It is not personal financial or tax advice. Identifying these specific deductions transforms the pay stub into a legible tool for tracking exactly how your cash flows from your employer to your bank account. The United States tax system operates on a pay-as-you-go basis, collecting income taxes in real time throughout the year. This structure is designed to keep taxpayers current. By breaking your tax liability into 12, 24, or 26 smaller increments, it prevents the shock of an unpayable lump sum bill when tax season arrives in April. Those gradual payments are sent directly to the Internal Revenue Service. Your employer doesn't keep the money they withhold. They act as a real-time intermediary, legally obligated to route your estimated tax payments to the government on your behalf. To read your pay stub accurately, you need to divide it into two distinct categories: mandatory systems and variable estimates. The most prominent mandatory deduction is FICA, the Federal Insurance Contributions Act. Originally established in the 1930s, this tax was created to fund Social Security. The Social Security component of FICA is a fixed rate. You pay exactly 6.2% of your gross income. However, there is a ceiling. It only applies up to a wage base limit of $184,500 for 2026. Income beyond that is exempt. The second half of FICA is the Medicare tax, added to the system in the 1960s to help fund healthcare for older Americans. This is set at a rate of 1.45%. Unlike Social Security, the Medicare tax has no wage cap. It applies to every dollar you earn. And for both of these FICA taxes, your employer is required to match your contributions dollar for dollar. FICA is a systemic, flat requirement. As an employee, you cannot adjust or negotiate how these specific deductions are calculated. But there is a line on your pay stub that you can control: your federal income tax withholding. This amount isn't a random guess. Your employer calculates it using the exact instructions you provide on Form W-4. The most critical instruction on this form is your filing status. Whether you file as single, married filing jointly, or head of household, this selection tells your employer which tax brackets apply to you and ensures your standard deduction is protected from withholding. The form also asks about dependents. If you have children and qualify for the child tax credit, noting that on your W-4 allows your employer to mathematically reduce the amount of tax withheld from each check. If you have multiple jobs or a spouse who also works, your household income spans across higher, overlapping tax brackets. The W-4 provides a section to coordinate these factors, ensuring enough money is withheld to cover your combined tax liability. Depending on where you live, you may also see variable deductions for state and local income taxes. Though if you reside in one of the 9 U.S. states without a state wage tax, this line simply won't exist on your pay stub. While FICA is rigid, your federal income tax withholding is a flexible estimate. Its accuracy depends entirely on the information you put on your W-4. Before those variable taxes are even calculated, you have the opportunity to use voluntary paycheck deductions, like health savings accounts, flexible spending accounts, and traditional 401k contributions. This illustrates why these are called pre-tax deductions. The money contributed is removed from gross pay before federal income taxes are calculated. By contrast, post-tax deductions, like a Roth 401k, are taken out only after the tax calculation is complete. Pre-tax deductions are a powerful tool. By using them, you actively save for your own healthcare or retirement, while simultaneously reducing the total amount of your income exposed to federal taxes. All of this math culminates every spring during tax season, when Americans receive a tax refund. This refund indicates the amount withheld throughout the year exceeded your actual tax liability. Choosing a large refund means you withhold more money than necessary, providing the government an interest-free loan until April. The alternative is minimizing withholding to maximize immediate cash flow, but you risk a balance due. This is not a pass-or-fail math test. It is a deliberate lifestyle choice. There is no wrong answer, only the strategy that best aligns with your personal financial goals. Major life events, getting married, having a child, or receiving a significant raise, alter your tax math. This is when you must recalibrate your withholding strategy. The IRS offers a free, secure digital tool called the Tax Withholding Estimator. It allows you to model these life changes and check your math before you ever submit a new W-4 to your employer. To tailor these concepts directly to your situation, consulting a CPA or qualified tax professional is always the most effective way to map out your long-term roadmap. Decoding the mandatory taxes and strategic deductions on your pay stub provides the clarity needed to align your monthly paycheck with your long-term financial goals.